Hey guys, all content discussed in this channel is due diligence gathered with aim at better understanding the nature of the current market in anticipation of the greatest squeeze in financial history. Let's dive in. Today I was bombarded left and right with people asking me what I think about the new proposal by the NSCC to stop MOASS. On Reddit, Twitter, Discord and YouTuber, everyone is freaking out and demanding prompt action while getting the pitchforks ready. Reading directly from the new proposal rule, on page 6, it read, and I quote, "In addition to creating capital efficiency opportunities for market participants, NSCC believes that broadening the scope of central clearing at NSCC to SFTs would also reduce the potential for market disruption from fire sales. In the case of securities lending transactions, the primary risk of fire sales relates to the reinvestment of cash collateral by institutional firms that are the lenders in securities lending transactions. Those institutional firms will typically reinvest the cash collateral they receive from the borrower into other securities. If the borrower of the securities thereafter defaults, the institutional firm lenders generally need to quickly liquidate the securities representing the reinvestment in order to raise cash to purchase the originally lent security. A substantial number of disconnected and competing liquidations by multiple lenders can create fire sale conditions for the securities being liquidated, which can harm not only the institutional firm lenders by potentially lowering the amount of cash they can raise in the sale of such securities, but also create market losses for all holders of such securities. Moreover, if an institutional firm lender should default and fail to return the cash collateral back to its borrowers, the borrowers would typically be looking to liquidate the borrowed securities in order to make themselves whole for the cash collateral they delivered to the institutional firm lender. Competing and disconnected sales of such securities could similarly create fire sale conditions and not only harm the borrowers to the extent the value of the securities decline, but also create market losses for all holders of the borrowed securities. NSCC believes that broadening the scope of central clearing at NSCC to SFTs would reduce the potential for market disruption from fire sales for a number of reasons. First, in the event of a default, NSCC would conduct a centralized, orderly liquidation of the defaulter's SFT positions. Such an organized liquidation should result in substantially less price depreciation and market disruption than multiple independent non-defaulting parties racing against one another to liquidate the positions. Second, NSCC would only need to liquidate the defaulter's net positions. This portion that I just read is what has everyone shitting bricks. The general understanding seems to be that the NSCC understands there is a large number of FTDs, of naked shorts, that need to be cleared. Because they are scared that MOASS will essentially break the entire stock market, they are now trying to quickly pass this proposal, which by the way is about 200 pages long, which under the common understanding of a lot of folk, allows shorters to avoid many of the obligations that would force them to cover and cause the mother of all squeezes. Under this understanding, it introduces a new transaction layer that replaced some of the obligations lenders, short sellers, prime brokers and other bodies. This replacement will be done by allowing shorts in particular to get more lending of securities. In a more smooth explanation, the common belief now is that this works similar to the overnight reverse repo program, only that it is directed to failed to deliver shares. Shorters would be allowed to borrow shares anytime at whatever amount they want with little to no worries. What is really stressing is that they can get collateral requirements off of the initial price of the stock they want to borrow. This would have the implication of them avoiding to have to pay huge money covering once the squeeze starts because they would just have to pay based on the initial price of the stock, like I said. This would essentially be the ultimate trap card to MOASS and therefore make it impossible for them to be forced to cover, which would defeat everything we have done and they get to win. Now, I can already feel the high blood pressure mounting up from everyone watching this video. So before you get ready to get your pitchfork and go all up in arms, let me add that there is a strong possibility here that this is a very serious misinterpretation of this rule. In fact, I strongly believe that this proposal would not stop MOASS, nor is it intended to do so, and I am going to explain to you why. Let us begin by addressing the big elephant in the room for anyone that has taken the time to look over the proposal document. It is over 200 pages and it's an absolute mess to read, digest, understand and more so, to explain. These legal documents are written in such ways that are complex and hard to read because they are trying to either implement loopholes into the laws or make it impossible for them to be any, so reading it is a jargon and tedious task. This is paramount to understand, because again, the document is 200 pages long but people are obsessing over just page 6 and 7. They read a paragraph with little context, are pumping it for clicks and karma on Reddit, Everyone is freaking out emailing the SEC on a document that they themselves admit to not even understanding and are causing chaos. If this blows out of proportion enough, it could be counter-beneficial for us, as we will be seen as a bunch of idiots who make things out of nothing. So please let's all come together, wait and see what the brighter minds have to say and put it all together to form a rational conclusion. My take on this is that the Fed's SFT is very hard to understand and allows for a lot of room for interpretation, causing people to fill in the blanks as they want. The entire document talks about novation, which means replacement, for current agreements between lenders and borrowers where the NSCC is counterparty to. At no point in this agreement, based from what I read, does it ever talk about erasing the loans from the books, so this by itself puts the general understanding of SuperStonk, which are the ones driving this understanding we just explained, into question and possibly FUD. What is actually being said, so far as my understanding goes as well as some of the other people I have seen commenting on it while reading, is that the NSCC is proposing to set up a settlement system similar to that of the CNS which settles most stock transactions in the US now. Let me now sprinkle glory to it all. This new system would be new and I don't understand a lot of the jargon in it, so I do not know how this could affect retail. Again, this means I don't understand how this would affect us, not that it is bad in any way. We just need a bit more clarification on some key issues here. What I do know is that nothing here prevents them from covering, nor do they get to find a loophole that allows them to offset their obligation to be forced to cover as the squeeze happens. I must say again, this 200-page document is not only big, but the wording in it makes it incredibly hard to grasp and understand. What I know is that this will not stop MOASS. Nothing in the document shows or gave me the impression it is trying to stop the squeeze, nor find ways for big money to never cover anything, which is what SuperStonk and the rest of the sheep pumping the FUD are doing. Even on SuperStonk, all the posts are saying contact the SEC and calling for action, but everyone is saying they don't even understand what is happening nor what the document says. Stop freaking out over something you don't understand, and more importantly, stop calling the end of MOASS for clicks and giggles. We went from 0 to 10 without even knowing why. MOASS is unstoppable, it's just not going to be as quick as people thought it would be, and that is what is driving people so anxious. This will take its time, so stop listening to influencers pumping MOASS every day because it will not happen today nor tomorrow. Nobody truly knows, but we can anticipate that it needs to be brought forth by a big economic event that would force shorts to begin cover, or by producing evidence suggesting we own many times the float, which is one of the main purposes of for why people are storing their GME and AMC shares in ComputerShare. Find peace in stock boredom, because this stock is fun for 2 weeks and then boring for 2 months before the next spike. Don't obsess with MOASS every day and simply go about your day and buy when you can and hold, and when the day finally comes, then feel free to freak out. Now, with all the FUD clapped and settled, today the stock market was very mixed. Netflix got absolutely buried yesterday after a very poor performance and an even worse outlook for the future. The price is down more than 66% since the beginning of the year, and because Netflix is such a big and important company, the ramifications of its downfall are having very serious effects everywhere and compounds investor worries. The Dow Jones was the only benchmark that ended the day green. The S&P 500 lost 0.06% and Nasdaq fell 1.49%. On a more positive note, Tesla revenues grew 81% from last year. They beat expectation, as the earnings per share came at $3.22 versus the expected $2.26. Revenue came in at $18.76 billion versus the expected $17.80 billion. This could have very serious positive effects tomorrow on the benchmarks. GameStop nor AMC had any news today. What was amazing though was our day trades today. There were 3 total alerts, and though all 3 were very profitable, one ended up running up over 70% from the moment the alert went out. After that, I called the perfect place it would dip to, and members of the Discord bought in at said price, enjoying a nice 20% return on investment on top of that 70%. It was an absolutely amazing day to trade even when the markets were going down. I seriously encourage you guys to come over to the Discord and see for yourself what we have to offer, especially if you are a day trader and want to get very accurate alerts. The Discord link will be in the comments section and in the video description. Let's now talk about today. The Fed submitted over $1.866 trillion in reverse repo operations today. Dark pool trades for AMC accounted for 49% of the total volume today, while dark pool trades for GameStop accounted 52% of the total volume today. AMC had a larger amount of buy orders than sell orders, with GameStop also having a larger amount of buy orders than sell orders. AMC had a bearish day, losing over 7.17%. It opened to a pretty big dip that brought it down from 18.70 to 17.60. After finding support here, it began trying to inch up, testing 18.10 before falling back down, closing at 17.34, below the VWAP. Support will be found at 17.20 and 17. Resistance will be met at 17.60 and 18. GameStop had a bearish day, losing over 2.37%. It opened to a dip that brought it from 153 to 147. After this dip, it remained trading sideways for pretty much the rest of the day, with one exception in the middle of the day where it failed to run past 152. GameStop traded sideways the entire day and closed at 148.85, below the VWAP. Support will be found at 142 and 138. Resistance will be met at 152 and 156. I highly encourage you guys to come over the Discord, as we just reached past 6,000 members. You will find tons of active traders talking about GameStop and AMC and other meme stocks and crypto in the markets. It is a very engaging atmosphere, and even more so if you are looking for a serious day trading group. Links will be down in the video description. Thank you again for being a part of this channel. I will continue striving for better content. Enjoy the rest of your day, keep on buying the dip into the moon.